Hello and welcome to my latest video. The subject is how to reduce your capital gains tax liability. Now I know it's a little bit early in the year, we're only in August as I speak, and the tax year doesn't end until the 5th of April 2021. Nonetheless, you can never plan too early. Now, capital gains tax receipts last tax year, 2019 to 2020, reached £9.1 billion, which is still a relatively small tax take. I calculated that it's just a little over 1% of all taxation incurred and collected by the government in that tax year. And really, a very small percentage of people pay capital gains tax, only about 1%. Nonetheless, when you do get the bill, it's quite a big price to pay sometimes, especially if it's a large asset you've sold, such as a big business or a property. The point being that it was only 10 years ago that the total tax revenue from capital gains tax was 2.5 billion. So it's risen from 2.5 to 9.1 billion. That's an increase of nearly 300%, so not to be underestimated. Now, what do you pay capital gains tax on? You pay capital gains tax when you sell certain assets, or you transfer, or even just gift them. Believe it or not, a gift can still incur capital gains tax. Now, the most likely sources of capital gains is going to be on the sale of shares, or followed by the sale of property. And for those people who are lucky enough to have successful businesses, maybe the sale of business as well. And it can be quite substantial if it's a very successful business. So it's important to know what the capital gains tax exemption amount is, and it's £12,300 per person during the current tax year, which is the 20 to 21 tax year. Now, if you are a basic rate taxpayer, then for most capital gains, you'll pay capital gains tax at 10%. If you're a higher rate taxpayer, you'll be paying tax at 20%. So it does depend on your tax band. The previous rates were 18% for a basic rate taxpayer and 28% for a higher rate taxpayer. Now those rates have been retained, but only for the sale of residential property. And when I say residential, we're talking about investment properties such as buy-to-lets. So it just seems that the government has got it in for buy-to-let investors, and so therefore there's more penal tax rates to pay. There is also something known as entrepreneurial relief. So if you run a business and you own the shares for more than 2 years, then when you come to sell that business, you're only subject to a capital gains tax rate of 10%, no matter what your normal tax rate is. Now, the limit used to be based on capital gains of £10 million a year, but the Chancellor last March reduced that to from 10 million to 1 million. So really, as long as your business is sold for less than 1 million, you still can benefit wholly from that 10% tax rate. So the question is, what kind of strategies are there for reducing your capital gains tax? Well, the obvious one is use your allowance. You've got an allowance of £12,300. Each individual is entitled to that, so husband, wife, even children, even minor children, in other words, children under the age of 18. Every one of us in the UK has a capital gains tax exemption, so it's important to use it. Now, how do you calculate your capital gain? Well, it's really just the profit on the sale of an asset. In other words, you buy shares for £10,000, you sell them for £20,000, your gain is £10,000. That's your capital gain. If your annual exemption is £12,300, then the £10,000 falls below £12,300. So there's no capital gains tax to pay in that example. So what other things can you do? Well, you can also, if you have a loss, for example, you buy some shares and you lose money, and in the same year you make money on shares, you can offset the loss against the gain. And if there's a net loss for that tax year, so in other words, losses are greater than your gains, you make losses of 12,000, you make gains of 10,000, you got net losses of £2,000 to carry forward against future capital gains in future tax years. So that's important. Now, Another thing you can do is you can invest your money, instead of buying individual shares, you can invest money in a fund. Now, many of our clients in the past and currently have invested in Parmenion and Standard Life wrap accounts that consist of many funds. Those funds, if they're held in pensions or ISAs, are capital gains tax free, but if they're held in what's known as a general investment account, then they could potentially be subject to capital gains. So, but the actual fund itself, where the money's invested, a fund manager is investing in typically 40 or 50 shares. They'll buy and sell the shares. You won't personally pay capital gains tax on the gains of any of those shares dealt with within the fund. So what else can you do? When you've got funds or shares, you can, for example, sell them one day to realise a gain and buy them back the next. So you buy them at a higher cost than you originally bought them for. It's called rebasing the cost of the shares. So you sell shares for 10 grand, the value goes up to 20, you sell them for 20, you make a gain of 10, no capital gains tax to pay, and the same number of shares are now worth 20 grand because you've rebought them the next day. The trouble is you get caught out by this 30-day rule. If you buy the same shares or the same fund within 30 days of selling them, then you don't get the capital gains tax rebasing. You treat it as though it's the original cost of the shares. There are a few simple ways to get around this. One is to do what's called bed and ISA, where you sell the investment and rebuy it in an ISA. That doesn't count as being caught by the 30-day rule. The other thing is bed and SIP. In other words, a SIP is the name of a self-invested personal pension. You sell the investments that are taxable in your general investment account, reinvest into a pension scheme. They're not caught by the 30-day rule. A third thing you could do is to sell the shares and your partner or your spouse could buy them back in their name. So there's 3 strategies there where you can take advantage of this rule so you don't get caught by the capital gains tax there unwittingly to increase your ability to save tax. What else can you do? Well, another classic thing, because the capital gains tax is based on your tax rate, so if you're a higher rate taxpayer, you pay the higher rate of capital gains tax I alluded to earlier. If you're a lower rate or zero taxpayer, then you'll either pay a 10% rate or zero if there's no gain. So what you can do, the higher rate taxpayer can gift the assets to the lower rate taxpayer, such as a wife, for example, from a husband, and then when that person then sells, then they'll pay tax hopefully at a lower rate if they still remain a lower rate taxpayer or basic rate taxpayer when they sell the asset. That's another way of doing it. Another classic thing to do is to not pay the tax twice. How can you pay it twice? Well, it's important to be aware that on death no capital gains tax applies. So if you have unfortunately a terminal illness, you've got reduced life expectancy, or you're quite elderly and you don't expect to live many years, then rather than sell assets such as shares and trigger a capital gain that could suffer you tax of anything up to 28%, why pay that when you're going to have to pay inheritance tax only on your death? So if you pay 28% tax today and then die very shortly afterwards, then you've got a further 40% inheritance tax to pay on that same asset that suffered the taxes of up to 28%. So that's a bit of an own goal, effectively paying the tax twice. There are other more sexy schemes known as Enterprise Investment Scheme and its cousin, the Seed Enterprise Investment Scheme, or Seed EIS. These schemes are great ways of deferring capital gains tax and potentially eliminating it with careful tax planning. So you have a capital gain, the gain gets reinvested, not the proceeds, the gain gets reinvested into an EIS or Seed EIS, and the advantage of that is that that amount of gain can be deferred for at least 3 years. In my experience, it typically is longer than that, maybe 5 to 8 years it could take before you can sell that investment. Another advantage of EIS and Seed EIS is you get tax relief on the investment, 30% for EIS, 50% for Seed EIS. Now, because it's such a tax generous type of investment, unfortunately there is a price to pay for that. And one of the prices is that these are more illiquid investments because they're unquoted companies and they're higher risk. So you'd only really typically invest a small percentage of your overall wealth into such schemes, but it can be suitable for certain higher rate taxpayers, high earners, sophisticated investors who really know what they're doing and can be patient, because your money can be tied up, as I said earlier, for a long time. It can be, as I said, 6, 7, 8 years, although technically it can be as short as 3 years. In practice, it takes longer because these companies need to be sold. They're not quoted on the stock market. They are unquoted shares, higher risk, and therefore more what we call illiquid, because there's not a ready market for the shares. So quite a clever scheme, but not right for many people. It's right for some, but you really got to know what you're doing and take professional advice. Now, the ultimate way to avoid capital gains tax altogether, apart from dying, which none of us want to do, of course, is to become non-resident for tax purposes. Now, I did mention in a previous video, my last video, about the advantages of tax havens such as Isle of Man and Jersey, where there are no capital taxes. Now, if you were to, for example, emigrate to the Isle of Man and subsequently sell, let's say, a very valuable business and incur capital gains tax, well, the fact that you've emigrated means you're no longer subject to UK capital gains tax, as long as you can prove that you have become non-resident and that it's going to last for at least 5 tax years. Now, the other important thing to remember is that if you're emigrating abroad and you save the UK capital gains tax, don't then move to another tax jurisdiction which also subjects you to capital gains tax, because you could be subject to capital gains tax on that gain in the new country instead, in which case you've committed a big own goal, not to be recommended. So if you are going to emigrate, and really it's suitable this if you were considering it anyway, I don't think many people would just emigrate just in order to save tax. Make sure you go to a tax jurisdiction where you know there's no capital taxes, and take advice on that, of course. So that's a good way of doing it. So, on that note about taking advice, with any capital gains, it's always a good idea to take professional advice, because you want to be able to minimise those taxes. Capital gains tax, like many taxes, is a complex tax. So do take that advice. You know it makes sense.